I don't know how many family members you're supporting. Okay. So you don't have anybody that you might want to send to university or any of that stuff?
No.
Okay. So you don't need to share your income with other people?
Not unless I could cat.
No. Sorry, cats don't count as people in the tax system.
I don't believe so, because I know people from
Okay.
my husband's business, he already has his own business, and back when I was first in real estate, had no income.
Yeah.
We shared my income with him.
Okay.
To bring his tax rate.
Yeah. The next question is, are you going to spend on living expenses all the money that you earn in your real estate business? Because if you are, incorporation doesn't make any sense.
How are you?
But if you want to accumulate wealth, then it makes sense to accumulate wealth inside the corporation, because you've got 86 cents left in the corporation after tax.
So it does make sense.
And then you can pay yourself whatever you need for living expenses by way of dividend from the corporation.
Right. And if you do that, you get a tax that you pay on financing.
That's right.
Okay.
And the worst rate at the moment on a dividend is 1/3.
So it's still not as high as just putting everything.
Well, comparing, if you say you've got 14% corporate tax and you've got 1/3, say 35%, okay, so you're looking between the two at about 49% total. And that, in some circumstances, depending on your income level, would be more tax than you would pay if you were not incorporated.
Oh, gotcha.
So a lot of it depends on the numbers.
Yeah.
Okay. So if you're making, I don't know, $70,000, $80,000 a year in your real estate commissions after expenses, incorporation probably makes sense. But if you're only making, say, $40,000 after, no, incorporation doesn't make any sense to you at all. So, because there's extra cost. I mean, it costs you $1,500 or thereabouts to incorporate.
Correct.
And then
That's a one-time fee, right?
Yeah, but then you've got to file a corporate tax return as well as a personal tax return every year. So that'd be an additional cost. So I can't answer your question without seeing numbers.
But my accountant should.
Yeah. It doesn't make a lot of sense to a rental property, you mean? Rental income in a corporation is taxed at a higher rate than 50%. So you don't want to be running your rents through a corporation. Is it residential rental property or commercial rental? Own it yourself. Because if it's not going to make money, maybe. And the other thing is, yeah, how are you going to buy it? Are you going to borrow money to pay for it? Oh, okay. So you own it. You got a mortgage on it? Yeah. And it doesn't make, at this point, it's too late to consider a corporation anyway. Because you'd have to pay deed transfer tax and all kinds of stuff to put it into the corporate name. What you might do is have your company, if you've got a limited company for your real estate business, you might want to consider having your real estate company charge management fees on your rental property to bring the rental income down, and the active and charging a fee for managing the property is active business income in your corporation. Yeah. Yeah. That's a good idea. See, yeah, it's not a bad idea to put your rental property in a trust. And then depending on who, it doesn't really change anything. See, what you do is you put the property in the trust, the property makes money, and the trust has income. Now, the trust needs to allocate that income to its beneficiaries, because the trust, if it pays income, your trust is going to pay tax at the highest possible marginal rate, which in Nova Scotia could be as high as 50%. Okay? So what you do, you put the property in a trust, and you have whoever you want as beneficiaries of the trust, and then the trust can allocate the income among different family members. Yeah. No, because essentially you'd set up the trust so that it's what they call a discretionary trust. So the trust has discretion as to whether it allocates income out to individual beneficiaries, and it doesn't have to be even among the beneficiaries. Okay. Well, if this is my audience, we'd better get going.
There is 3 online.
Hello, people online. Nice to hear from. Well, you can't hear. I can't hear you, but you can hear me. I guess you're all there, which is more than I am. Okay, if anybody asks me a question, I will repeat the question so that everybody who's online can hear it and understand it. And if anybody who's online wants to ask a question, I guess you just type in and say, what about this? Or what about that?
Aaron's tasked me with trying to read that.
Yeah. So if there's any questions, okay. So welcome everybody. You all know, of course, that you live in the highest taxed province in Canada. Nova Scotia pays more income tax and more sales tax than any other province. Some basic rules of income tax. Oh, before we start, since those are listening in, I have written up on the wall here, don't be afraid to ask stupid questions. The reason for that is they're easier to deal with than stupid mistakes. So any question you ask, somebody else probably wants to know the answer. We're in the highest tax province in Canada. Here are the basic rules. First of all, in Canadian income tax law, you're guilty until you prove yourself innocent. So make sure you've got good documentation. The second rule of tax is no receipt, no deduction. And the third, you should understand that there's no such thing as fairness in the tax system. Politicians will tell you it's fair, but those of us who are out there earning money know full well it's not fair. Income tax is a tax on initiative. It's a tax on inventiveness. It's a tax on thrift. And worst of all, it's a tax on hard work. And the harder you work, the more income you make, the higher the tax rate on your income. I'll talk a little bit about whether you should incorporate your real estate business. In Nova Scotia, the lowest personal income tax rate is 23.79% on the first approximately $30,000 of profit that goes on your tax return. If you're unincorporated, you're a proprietor, that means your real estate income is added on to all of your other sources of income. If you're like me and you're old and you get pensions, not too many of you look old enough to be getting pensions, but if you're old like me and you get other income, like I get income from investments, I get income from other, and so if I was not an incorporated business, then all the profit I make is added on to my other income and it mounts up, and the more income you have, the higher the rate of tax you pay. If you're lucky enough to make $150,000 in income, then your tax rate on the next dollar after that is 50%. At 150 up to 150,000, the tax rate's probably only about 47%.
So the first 30 is 23.
It's 29,000 and a few hundred. So using round numbers, $30,000, your tax rate on that $30,000 is 23.79%. As an unincorporated business, you also have to pay 9.9% of your business income to the Canada pension ripoff plan, sorry. Okay, so as an unincorporated proprietor, you're looking at a minimum tax rate of just under 34% of your income. Now, against that you do get personal credits, etc., etc. If you incorporate your professional income, your corporate tax rate at the moment in Nova Scotia on the first $350,000 of annual income is 14%. So if your plan is to earn money and accumulate wealth for retirement, it makes more sense to run your business through a corporation because you've got 86 cents left after tax to invest in your savings. How do you pay yourself? You've got to live. So there's no point taking a salary from your corporation because you're back into your corporation saving 14% by claiming the expense, and you're going to pay 30% plus on the income. So it's not tax effective for you to pay yourself a salary from your corporation. So the much better way to go is to set yourself up. You're a shareholder of the corporation, and the corporation can pay dividends to its shareholders, just like the Royal Bank does, or Scotiabank, or Apple, or Microsoft. They all pay dividends to their shareholders. This corporate structure enables you to income split with other family members. I, for instance, have a wife and 3 adult children. It's not long since they were all in school. So once they're over 18, you can make them shareholders of your company and you can pay the family members dividends. And from a federal income tax point of view, an individual with no other income can earn $30,000 a year in dividends and pay no tax. No income tax, that is. Then it's just added on, and whatever the rate is, that's it. It's still cheaper to get dividend income than salary when it comes to personal tax. So in my case, I have a wife, I have a number 1 son, a neglected middle daughter, and a little stinker. Each of us, 5 of us then, if there's enough profit in the company, each of us could take $30,000 in dividends, pay no federal income tax. We will pay Nova Scotia income tax, because like I said earlier, Nova Scotia is the greediest tax province in Canada. Was that a question? No? Okay. Now in Nova Scotia, they just changed the rules so that in 2015, once you get $12,000 in dividend income, you're going to pay some provincial income tax, but it's not much. So by and large, it still makes sense to take dividends for your own lifestyle from a corporate activity. Now, having said that, if you're going to take all the money that you make in your corporation out of the corporation for your living expenses, it's no point being incorporated because the combined tax rates between you and the corporation just eliminates any advantage from having a corporate. If you're going to income split, that's fine. You take all the income out and split it among family members, fine. But if it's just you, and maybe you have a spouse who's already successful with a big paying job or their own business or something, and you're going to take all the money out to live anyway, don't waste your time incorporating because it's an added cost that you really don't need. Any questions? Okay. So I've talked about the advantages of incorporating. What I did in my corporation is, as we made money, so I put it in the stock market. So now I'm not quite retired, but I'm getting very close. So my company now isn't a business, it's an investment holding company. And it just keeps on going forward. And I would rather accumulate wealth inside my corporation than buy registered retirement savings plans. Okay, you get a deduction on an RSP when you put money in. But if you're taking dividends out of your company, you don't have RSP contribution room from your dividends anyway. They have to be from either wages or active business income or rents. Rents qualify as, you can get 18% of your rents as RSP room. And by the way, the question has been asked, should I put my rental property in a corporation? The answer to that is generally no. If it's just a one building situation and you run it yourself, if you put it into a corporation, any profit that's made on the rental property is taxed at the highest corporate tax rate, which is approximately 50%. So you really don't want to have your investment properties in a corporation. The rule changes if you have enough rental properties and 6 employees working for you in the rental properties, then that becomes an active business and the tax rate goes down to 14%. You may need to have awareness of that because I'm sure you all have clients who may or may not have multiple residential rental or even commercial rental properties. You need 6 full-time equivalents.
So I put together a team of 6.
Yes?
6 partners.
Yes?
As partners.
Yes?
Okay. So first department better limited set up for the 6.
The question was asked, if I put together a situation where we've got 6 people who want to buy jointly a rental property, would those 6 people make it a low income tax? And the answer is no, because those 6 people would not be working full time in that rental property. I would advise your clients to set up a holding company, which is it owns the property in trust for the individual owners. So the company itself doesn't pay any tax. It allocates the profit out to the individuals, and then they can pay the tax on it. I can't remember the actual term for it. But you set up the corporation to own the title of the property, but it's just a shell to take registered ownership of the property. And on the mortgage, I mean, all of the individuals would be guaranteeing the mortgage, but the mortgage would probably be in the corporate name. Okay. House expenses. Did you know that as self-employed people or people running your own business through your own corporation, you may be able to deduct from the income use of your home as a business office. You need to have totally separate, distinct place separated in your home from which you do your business. And you have to either meet clients or have files, or it has to be what you call your principal place of business. You're all basically self-employed. You're not employees of Keller Williams. And therefore, you reasonably have a chance, if all your files are at home and you run your thing from home and you've got your phone and all that other stuff, then there's a reasonable chance that you can deduct a portion of your home expenses against your real estate income. What you have to do is you have to say, well, there's the space that I use only for business, and it can't have a pool table in there, or a TV, or maybe a screen anyway that you can use for your computer and stuff. If you've got a separately designated space in your home, then you can take and prorate your home expenses and claim a portion of it against your income. If you're incorporated, you charge rent to the corporation for the business use, for the space that you use for business. You calculate that rate based on the same formula as you would use if you were on a self-employed doing a T2125. And then your home expenses, your electricity, your mortgage interest, your heating, water, property taxes, maintenance, yard work, add it all up. And then you say, well, the home's 2,000 feet, and this particular room is 200 feet. So you can claim 1/10. Okay? No, if you have an office here that's yours and nobody else can use, then no, because you've got an office here. If you pay rent here for the use, whatever Keller Williams charges you against your commission income is all deductible against your income for tax purposes.
We have two examples. Like,
Okay?
so, X number of dollars per month. But if I have home office, still portion to show that it's a play.
Okay, the question is, I have an office here in Bedford. I also have a home office in Porters Lake. Can I claim the home office in addition to the office here in Bedford? The answer is no. Now, Porters Lake is too close to Bedford. Okay, yeah, but I mean, unfortunately, Porters Lake is still in the same municipality as Bedford. If you had an office in Truro, fine, okay? But Bedford and Porters Lake, under the legislation and the way CRA applies it, I'm sorry, I mean, put it this way. Under the tax system, you can put what you like on your tax return. Okay? Yeah. And you don't really want them coming back. Now, sorry, go ahead.
So, this is actually, so in that office is under L's. Still right off.
You share an office here with somebody else?
With my husband.
Okay.
House are separate.
Mm-hmm.
And the bill goes,
Mm-hmm.
I work home.
Most of the time? Well, it's worth a try. Do you and your husband each have separate? So you each file as a self-employed individual? You should seriously talk to your financial or tax advisor to setting up a corporation that you both put the money in. But that's between you and your husband and your tax advisor.
For this year,
2015, I'd stick it in, yeah.
I always wrote it off.
Yeah. So they're used to seeing an office in home on your tax return anyway. Okay, yeah. The question for those listening in, the question was, my spouse and I both are real estate people, and we share an office in Keller Williams location, and the office is in the spouse's name. Can I now claim an office in my home? Probably. You can claim it. Now, the other thing you need to know is that Canada Revenue aims to audit about 5% of tax returns on an annual basis. However, real estate people and car salesmen are high risk for audit, much higher than the general population. Okay, so we've talked about that. We talked a little bit about home expenses. Cars. Write this down in big letters. Mileage log. Okay? If you're going to claim car expenses on your tax return or your company's tax return, you better have a credible mileage log. I won't say how accurate it needs to be. You just have to produce something. You can either use what I've got, a little mileage log that I keep in the car, and every time I go somewhere, when I get back to the office, pull out the mileage log, look at the trip meter, see how many clicks I did, and write that in the book. It's easy. So I leave the office, I push the trip meter to 0, drive to Keller Williams, do this, go back again, look at what the trip meter says, put it in the mileage log. Okay? The next thing is, if you're driving what the Tax Act defines as a passenger vehicle, don't put it into your corporation. If your corporation owns a vehicle that's a car or an SUV or a Dodge Grand Caravan or equivalent, primarily for the use of carrying passengers, then there's severe tax consequences if you put that vehicle into the company. First of all, the company can only claim depreciation on the first $30,000 of the cost of that vehicle. So if it's a $50,000 vehicle, you're losing out. Secondly, if the company owns the vehicle and you have access to a key, even though you may not use it, the law requires that the company gives you a T4 every year for 36% of the original cost of that vehicle. And that is not restricted to 30,000. So if you have a $50,000 vehicle owned in your company's books, the company is obliged by law to give you a T4 for $18,000 every year that the company owns that vehicle. Not a good plan. So what you do is you own the vehicle personally and you charge the company mileage. And you can charge up until the end of 2015, 55 cents a kilometre for every business mile that your personal vehicle is used, up to 5,000 clicks. After 5,000 clicks, they knock the rate down to 49 cents for every other kilometre that you use in the year. Now, I have to tell you that the bastards have knocked the rate down to 52 cents for 2016 on the basis that they think gas is cheaper. So it's 52 and 46 for 2016. 52 cents on the first 5,000 clicks, 46 cents on all the rest. 55 and 2016, it's 52 cents for the first 5,000 and 46 cents for all the rest. I've been using my car for business for many, many years, and I've always made more on the business clicks by charging 52 or whatever cents it was per kilometre than it's cost me to run the vehicle. The beauty of it is that's a deduction to the company, but you don't have to include it in your income. You just have to pay the car expenses. Own the car, pay the expenses.
You charge it
Not on your personal tax return. No, it's a deduction to the company. Not only is it a deduction for income tax purposes, but there's also HST that you can claim, I don't know, 15 over 115. So if you put $115 worth of mileage on your car, you get a $15 deduction on your HST bill and a $100 deduction on your income tax in your corporation. If you're not incorporated, then you keep your mileage log, you add up all your car expenses for the year, and you divide it between what's business and not business. You need to know what your total clicks were for the year. So if at the start of the year your odometer says 20,000 clicks, and at the end of the year it says 50,000, you know you've done 30,000 clicks. And maybe you've booked 20,000 of that for business. So that means you can take 2/3 of your car expenses on your personal tax return.
What's your thoughts? You have more than one vehicle.
Yeah.
They're all personally owned by you.
Yeah.
One is a corporation. Only use that for business.
Mm-hmm.
Other car, all your personal time.
Yeah.
Then you charge.
You want, okay. The
95% of
yeah. The question asked for those who are listening in is, if you own two vehicles, can you use one of them exclusively for business and the other one exclusively for personal? There's a risk. Okay? CRA is never going to like 95% of a particular vehicle being claimed as business. But if you've got the mileage log, you can prove it. So as long as you can prove it, do it. That's for unincorporated businesses. If you're incorporated, it doesn't matter which car you use, you keep the mileage log. And it's purely paid on a per kilometre basis.
How detailed is your?
Well, in your circumstances, what I'd probably do, you have some kind of a day timer that lists where you're going on the course of the day. In theory. You have an appointment calendar. You must, otherwise you wouldn't know where you've got to be whenever you've got to be there. Okay? So I would suggest that where you're going to multiple places during the course of the day, you set the thing to 0 at the beginning of the day You know you've done in business at the end all day. So at the end of the day, you just record that day's kilometers. And you bill that to your company. As you say, it doesn't have to be written like mine just because I'm old-fashioned. You might be much more technologically advanced than I, and you can get an app on your either your iPad or your iPhone and automatically keep track of it. If you're willing to make the effort, the reward is there. So I think that's covered cars. No questions on cars?
And is it just
You might get away with it if you're unincorporated and you charge so much per kilometre to the business. But the CRA is much happier if you take your total car expenses and apportion them between business and personal. Just claim the personal. There's a schedule that you can fill in on your tax return called a T777, which is for car expenses. And you put your total car expenses in there, and then you say, this is how many clicks I used for the whole year, this is how many clicks were for business, and it prorates that, it prorates them between business and personal, and you claim the personal cost on your tax return against your business income. The next topic I have is business entertainment. Okay? Let me make it quite clear that golf is an absolute no-no. Golf, hunting lodges, and taking people to the metro centre, maybe. Not golf, not going out to a camp or a hunting lodge. Those are specifically proscribed in the Income Tax Act. Now, so your membership of the golf club, no. Playing around a golf with anybody, no. If you go to the golf club for a meal and you don't play golf, the meal can go on your tax return as an expense. If you go to the golf club and have a meal and then play around a golf, no. So. Nobody said, except politicians, that the tax system is fair. Okay? But if you pay for a round of golf, for you and another person, however much business you do or how many deals you do on the golf, sorry, the cost of the golf is specifically denied in the Income Tax Act as an expense on your tax return. And if your company pays your golf club membership, first of all, the company can't deduct it as an expense. And secondly, it goes on your tax return as a taxable benefit. Double tax. So stay away from golf when you're thinking business. Entertaining, meals and entertaining. If you take somebody out, say to the Metro Centre for an event, 50% of what you pay at the Metro Centre is a tax deduction on your tax return or your company's tax return. 50% of the HST component of the cost of the tickets is also a claimable credit on your HST return. So if you go, again, for the ease of illustration, you go and you pay $200 plus HST, $230 for an entertainment event for clients at the Metro Centre. First of all, you're only going to get $15 of that $30 as an HST input on your HST return. That leaves you with $215, and you're going to claim 50% of that $215 as a business expense. Just because you can't claim half the GST doesn't mean you can't claim half of the unclaimed part as part of your expense. Okay? Now, This may not necessarily apply to you, but for instance, if my office took everybody to Ashburn for an office party, as long as we didn't play golf, 100% of that expense is the deduction. So if everybody in the business goes somewhere, or if everybody has the opportunity to go, then that's not a 50% deduction, it's a 100% deduction. Otherwise, all meals, you only get 50%, both for an HST input and for a tax expense. Yep.
All meals, so if you take a pint of...
Yep. That's right. In theory, you're only supposed to get 50% of the client's meal, but we always claim 50% of all of the entire meal, including the booze and the tips.
You can...
Oh yeah, tip is part of your business expense. Meals. So meals. Oh yeah. If you have to travel somewhere overnight and you stay in a hotel or a motel and you eat in the motel or the hotel, make sure that they distinguish the meal cost from the accommodation cost. If they don't distinguish between meals and accommodation, then you only get to deduct 50% of the whole bill. As long as the bill distinguishes between meals and accommodation, the accommodation is 100% deductible and the meal's 50% deductible. Now, who wants to know about the gouge and screw tax? Okay. Are you interested in learning anything or anything I might be able to tell you about the GST, the gouge and screw tax? It was a gouge and screw tax until the early 1990s, and then the federal government thought, you know what, we're going to lean on the have-not provinces and make them blend their sales taxes with our federal sales tax. And they were going to call it the BST. Well, everybody knows what BS stands for. So they realized they couldn't call it the blended sales tax. So they changed the name of the animal from a bull to a horse. So now it's an HST. Okay, and if you're in business and you're going to generate more than $30,000 a year in revenue, then you've got to register and collect HST from your customers. You don't have to register unless, I'm sorry, you don't have to register if you are meet the definition of a small business, which means that if your annual sales in any 4 successive quarters don't exceed $30,000, you don't have to register. All that means is you eat the HST in the expenses that you incur to run your business. The way the HST works is you collect HST from your customers, you pay HST on your business expenses, you deduct what you pay from what you collect and send the rest to the government. In a business startup, it's often difficult to decide whether you should actually register right from the get-go. But if you're going to invest $20,000, $30,000, $50,000 in equipment and inventory in your business, then it makes sense to register right away, because then you can get back the HST that you pay on stuff that you buy to set up your business. What else would you like to know, folks? A quick method. So you want to talk? Alexa, can you mute, please? Who's Alexa? I don't see an Alexa on there. Oh, Sean and
Yes.
Rhonda.
Ta-da.
Okay. I hope you can still hear, folks. So what you're talking about is called the quick method of HST. First of all, you can only use it if your total revenue is less than $200,000 in the course of a year. And in a situation where you don't have very many expenses on which you can deduct HST, you may be able to, you can register to use the quick method of HST. What happens there is, let's say your revenue is, let's say your sales is $100,000. So you've got to collect HST of $15,000 in Nova Scotia. So now you've got $115,000. Okay? What you can do is you can say, well, I don't want to bother claiming my input credits. And if you elect the quick method, then all you've got to do is send in 10%. So you send in 11,500. Okay? So you have to send in 10% of this number. So if your input credits are any less than $3,500, it makes sense to elect. Okay? Okay, never mind. I'll go through it again. So you've got revenues of $100,000 and you have to collect HST on that. So you need to collect $15,000. So you're going to collect $115,000 from your customer, or in your case from Keller Williams, I guess. Okay? Now you've got two choices. One is you can send $15,000 to the government and from that deduct what your input credits are, whatever your input credits are. Okay? Or you can say, forget about input credits and just send 10% of $115,000. So you may, if you've got no inputs, you just made a profit on your HST of $3,500. So if your inputs are less than $3,500, you might as well use the quick method.
For a lot of new agents,
Yeah.
maybe they're on the team, their expenses are for the team.
Yes.
They're really into just, and then HST on the pass, that's actually a little better for do that.
They have to, I mean, you've got to work the numbers out.
Yeah.
Even though the expenses might be paid by a team, all of those expenses would include HST. So the input credits could be allocated among the team members. Okay? So I can't give you a definitive answer as to whether somebody should or should not unless I see specific numbers. So each person should be looking at the specific numbers of their situation to decide whether it's worth their while to go with the quick method or not. One of the other thing is, if you're using the quick method and you buy equipment like a computer, you can deduct the HST that you pay when you buy the computer from the 11,500 here. So you can use the quick method based on your revenue and expenses, but if you've got capital equipment that you need to buy, desks, computers, maybe a car that you're going to use in the business, then you can deduct the HST on those kind of things from this 10%, or in this illustration, 11,500. Okay? Good. How are we doing? Any more? I have here an amazing list of what you can and can't claim as medical expenses. And I'm going to ask you to copy it and give one out to everybody. You'd be amazed what you can claim wooden legs as medical expenses. Yes, sir.
Another question. See advertisements are popping disability.
Yes.
Don't know anything about.
Okay, the disability tax credit.
Yeah.
Certainly. I'd
Because
love to.
It seemed to me when I saw it, I thought of disability, fine wheelchairs, something like that.
When I first got into the tax system, in order to qualify for the disability tax credit, you had to either be confined to a bed or a wheelchair. The definition has been expanded greatly. Well, I have a mother. She's 94. By definition, she's disabled. Just by age. I have a grandson who's autistic. He's disabled. He gets a disability credit. And it's an extra deduction on your tax return somewhere around $7,000, which in theory means you get about $1,800 reduction in your tax bill by reason of claiming a disability credit. Somebody perhaps with one of these unfortunate armed forces guys who comes back missing a leg, he'd be disabled. People who are deaf, they're disabled. People who are blind, they're disabled. And they're all entitled to a disability credit. And it's amazing how many people don't actually consider themselves disabled. I have a client that runs quite a successful excavation company, but he has a condition that limits his ability to get about. Like he can't go out anywhere to work without wearing gloves. And he has to have all his teeth. I don't know what the condition is. But what you do is you get a form T2200 from the tax department, or go online and get one. You fill in your names and addresses and all the other details of you. Then you give it to your doctor. And he says, I can certify that this person is disabled because of whatever it is. We have a dear friend who came to Canada from England about 3 or 4 months after we did, and they became our close friends, and we've known them now for over 40 years. And sadly, last August or thereabouts, the spouse of the couple, the female, started getting dizzy fits. And it took the medical profession some time to realize that it wasn't vertigo, but she actually had a tumor. And they found the tumor in December. And she doesn't know what she's doing half the time. So she's disabled. So we've sent in an application, it'll come back, and she'll have a disability credit on her tax return. Now, if her income is not enough that she can use the disability credit on her tax return, she can transfer that to her spouse. Like my grandson, super little guy, going to be 7 next month. Everybody loves him to bits, and he just goes around like this all the time, flapping his arms. And he's a wonderful little kid, but he's disabled. Well, obviously, a 7-year-old doesn't have any income. So his disability credit can get put on his parents' tax return. And they then get the benefit of the tax credit.
So if that unfortunate
It's inoperable, unfortunately. Yeah.
I'm sorry to hear.
Yeah.
If it were, she.
The disability.
Would that she still be able to claim
The
that?
disability, essentially, the doctor has to certify that the disability is going to last for at least 12 months. In my friend's case, it's a case of it may not last 12 months because she's going to die. But they'll give her the credit nevertheless. Okay?
So is
Yeah.
there specific, or is that doctor's question?
You know what? If you go online to the Canada Revenue Agency, www.cra-arc.gc.ca, and type in, go Canada Revenue, yeah. Just boom, go on the site and type in disability, and there's all kinds of useful information that sometimes is even right on the CRA website. Well, one of my big beefs about the tax department is you can phone with the tax department, and if you get through, you can ask them a question. They'll give you an answer. And you can phone If you've got the time, you can phone 3 times, you'll speak to 3 different people, and I'll guarantee you get at least 2, usually 3 different answers. And the other thing that really gets up my nose is they are not held accountable for what they tell you. So you call the tax department and say, I need to know about this, and they say, well, you do that, that, and that. And you do that, that, and that. And then along comes an auditor and says, you can't do that. But you doesn't matter. You're on the hook. You're the one that's going to get nailed with back taxes and penalties and interest.
So it might not be correct on the site.
I can't guarantee it. Their website says what they think the law says. Okay? The law doesn't always agree with what they say.
Just curious about Crohn's disease.
I would suggest that Crohn's is sufficiently severe to warrant a disability deduction.
What about not?
That's an eyesight thing. If you can get the doctor to put it down on the form, I can't guarantee that CRA will accept it, but you've nothing to lose by applying.
All that is, that's not, that's disallows something.
Yeah. Well, first of all, you cannot claim the disability credit unless you've got a permission from the tax department to start with. So they have to send you a letter saying, yes, you can get the disability credit.
Oh, so you can't get this form filled out, claim it.
No. You get the form and you send it to the tax department. Then you have to wait for them to say yes or no. But in your case with the Crohn's disease, send it in, by all means.
Yeah. What about severe type?
I have no example of diabetes being used for a disability credit, but I can see no reason why it wouldn't be worth claiming. Like, I'm diabetic, but I'm type 2 diabetic, so it's pills and exercise. I'm not having to inject myself every 5 minutes. So I wouldn't consider that my type of diabetes is a disability. But I can see a reason for somebody who has to inject themselves on a regular basis applying, because it's got to restrict your normal daily activities to some extent.
Type 2, rest. Like you can't go,
Oh, I'd love to have a rest in the afternoon. My doctor says to me, I'll have to go walking for an hour a day.
The only thing I wonder about the diabetes one is there is an awful lot of thoughts that some of it is have the power.
Oh, I think
Increase your health.
my type.
I'm not a diabetic here, you say that.
There is a school of thought that some feel.
I completely think I agree. I'm diabetic type 2, and I think it's my own fault.
No.
yeah, maybe.
Or actually, it's my boss lady, the wife's fault, because she's fed me so well and let me get away with stuff.
It may be how you got.
Yeah, type 1 diabetes.
There is a predisposition in families and
Oh,
so
yeah,
on.
other than that,
So,
yeah, for sure.
you know,
But
To be honest with you, I'm not sure about, but it's certainly I wouldn't consider type 2 diabetes disabling, but type 1 may well be. Okay, so what else can you claim? The feds like you having children. Pardon me? No, but up to age 16, the feds at least give you a credit. Nova Scotia doesn't want you having kids. If you've got a spouse that doesn't work, as long as they don't make more than about $500 or $800, then you've got a dependent that you can claim for your spouse. If you're a divorced or separated person and you have a child dependent on you living with you, then you can claim that child as the equivalent to a spouse. If you have kids at university and they get a tuition and education credit, if they don't have enough income to use it, they can transfer up to $5,000 of that tuition and education credit to you or another supporting person. We get a credit now for a caregiver because we've got Granny living in her flat in our house. and she's considered disabled, so we get a credit on our personal taxes for a caregiver credit. It's not much, and it varies according to what her income is. Well, she doesn't get much except for OAS and guaranteed income supplement.
Question for you, two issues.
Yep.
Close to the same. Litigation in real estate.
Yes.
Some suit, have errors of omission.
Yes.
We have a big deduction.
Yes.
In other business, I've seen accounting, they set up, they say, okay, I'm going to provide something for that. Can you do that, or is that heard? Like, could you say
Okay.
every month, you're setting up a sinking fund
Okay.
of $200. Once you get up to a certain value, there, or
I would.
set on an expense per.
Yeah. Okay. The question was, somebody might think in case they get sued, they want to put some money aside to cover the deductible on the tax on the insurance policy. Is that a business expense? I would suggest to you, no, it isn't. I would suggest that putting money aside in case you get sued is not a business deductible expense. It makes a lot of financial sense to do it, but the only time you could actually deduct any amount that you pay out is if you're unsuccessful in defending a suit for liability, and then the cost of the defense of the liability. Well, even if you're successful in the suit, somebody sues you, you're going to incur a lot of legal expenses. Your insurance policy should cover most of them, but for that part that isn't covered that you have to pay yourself, that's definitely a business expense.
Next, moving on to the
Yeah.
next question.
Yeah.
On a car, appreciate it gets down road.
Yeah.
But got 250,000 clips on it. Is that on an accrued basis or set up? Can
Okay.
you have a fund
Yeah.
sinking, knowing that you're going to have to do it on? Whether you spend it certain or you spend it for can't do that.
Okay, the question is, if you have an asset like a car that's depreciating, and sooner or later you may have to replace the engine, can you set money aside to cover the replacement of the engine and claim that money that you set aside as a business expense? The answer is no. In fact, if you put a new engine in a car, it's quite possible that the CRA will say that's a capital addition to the car rather than an expense. Because you just turned an asset that you can't use anymore into something that you can use. And they probably want you to write that off over a period of time rather than claiming it all in one go. Anything on the wall? No, nothing on the wall. What a shame. Okay. Are there any other concerns or questions that any of you might have? Sir, you missed a bit about cars.
I apologize.
That's okay. No, you don't have to apologize.
$2,500 bill to fix my car.
Oh, I'd deduct the whole of that bill, especially if it's body work. Oh, okay. Yeah. I wouldn't have any bother putting that, including it. Well, it depends.
He drives a Volvo, he's not going to replace the motor.
It depends whether you're running your business through a corporation or whether you're running a business as an unincorporated proprietor. As a proprietor, you stick it in and you pay it. But if you're incorporated and your company owns a car, then you're only going to, first of all, the company shouldn't own a car because there's adverse tax consequences. If you buy a $50,000 car in your company, the law says you have to, the company has to give you a T4 for personal use of the company vehicle. And it's 36% of the cost of the car every year that you own the car. So if you buy a $50,000 car, then you're going to get a T4 from the company and pay tax on $18,000 every year. So after 3 years, you've paid tax on more money than the car cost you. So don't put your car into the company. Own the car personally and charge mileage to the company. Up until the end of 2015, that was 55 cents a kilometre for the first 5,000 in any year, and 49 cents for every other kilometre beyond 5,000. The government's now said, oh, look, the price of gas has gone down. So for 2016, it's not 55 cents a click anymore, it's 52 cents. And then after 5,000, it's reduced down to 46 cents.
So does that still apply?
Yep.
So
Yep.
So that's a
Yep.
better way, because is it correct that
Absolutely. The only thing you can do there is the gas and the insurance and the repairs and some depreciation on the car, but no loan interest. And never pay $1 for an expense just because it's tax deductible. It's no good paying $1 just to save 50 cents tax if you wouldn't have spent the dollar anyway.
When you come up, when you're buying a car, everyone has their sales pitch. Let's say it's $50,000.
Yep.
They say, tell you what, pay us $50,000 and have an interest of 0% for 3 years.
Yep.
Or if you pay cash, you have it for 40.
What would you do?
Well, that's
It depends if you've got to borrow the money to give them the $44,000.
exactly. But if you do a 0 interest on the car,
Yeah.
so you have a higher capital cost
Yep.
on the car, can you compute interest rate that you're really paying?
No. I mean, if you want to do the calculation and fight the tax department, fine. But the other thing that you need to know is that $50,000 car, you can only deduct $30,000 for depreciation purposes anyway.
So it seems to me when we look at cars, we're almost better off buy a 50 when it's 2 years old to get the price down to that 30,000 or whatever.
Yeah. Cars usually last longer than 2 years nowadays. I'm driving a $20,000 Dodge Grand Caravan. Suits me. Down to the ground. Does everything I reasonably could ask of it. And it has more use than a Honda. Unless it was a Honda van, I suppose. Okay. Any more? Thank you all for being here. And thank you all in there for listening.
I'll scan and email this.
Yeah, did you know that if you go on vacation and you buy travel insurance, that's a medical expense on your tax return?
Every time I send them to their account, oh, they come back, I can't hear. So I don't even know if I want to try again. This list might be useful for me.
Well, medical expenses are restricted to 3% of your net income. And in other words, if your net income is $30,000, the first $900 of medical expenses can't claim. If your income is $50,000, the first $1,500 of medical expenses can't claim. Once your income exceeds $60,000, in other words, there's a limit on restriction that you. Yeah. Yeah. Sounds like a business expense to me. If you use it for business and you prove that you use it for business.
So, Holm.
Yep. Yeah, if you rent stuff to use in your business, doesn't matter where you are, as long as you're using it for business purposes, it's a deduction on your tax return. Now you wouldn't be able to claim the rent for the condo. That's all. Sorry? What about them? Only if you're going somewhere for business purposes. Yeah. Like if you, I don't know, maybe somebody in Toronto wants to buy a property, you go to the agency and encourage the sale, that business.
What if you have to go home early from vacation?
The extra cost, as long as it was for business reasons, you could prove it for business. Yeah.
But if you, I think if it's a business,
Like a lot of our doctors and dentist clients go to conventions elsewhere in North America. Okay? Cost of going there, the cost of being at the convention generally accepted to go to a convention and then you stay for 2 weeks afterwards. You can't claim the 2 weeks, just the convention.
but if they're,
Oh yeah, yeah. If the main purpose of going is to the convention, fine. If the main purpose of going is for a holiday, you attend a convention while you're there. Well, you got some trouble.
but if you're in a group,
Yeah.
very specific, you totally function, and you've got classes at 8. This is not like cruise when you show up. But you actually go.
If it's a Keller Williams specifically, of course it's a Keller. They don't pay for you to go. Then you've got some expense.
They may question. That's what satisfied.
Essentially, I didn't write it. But guilty until you prove yourself. But if you're going to claim something, prove it. What CRA considers reasonable, not necessarily what would be considered. My pleasure. Thank you. I appreciate that. So keep up the good work. 65. Better work till you're 75.
Well, I heard today,
Well, we want to.
Trudeau is changing OAS to 60
Oh, yeah.
old age.
But you don't get that till you're 65 anyway. There was a plan to make it back till 67.
And he's
bringing it back
today
to
he
65.
announced that that's not happening.
Oh, well, he's an idiot. 65 is not, like, 65 is something